Yeah, so welcome to chapter 13. There's Clarissa coming back in. So yeah, welcome to chapter 13. Hopefully you can see my screen here and I'll be changing things as we go to different files, etc. And so what I thought we would do is we'll do the same kind of thing as we did last week is we'll ask some questions based on the content. Actually, before I get in there, I'm just going to quickly kind of summarize the chapter. And then we'll ask some questions based on the content, work through the solutions in a Google Doc like we did last week. And then it's really up to the collective, whether you want to go through some of the exercises and the solutions, like a few of them and go through them because they are a lot of repetition, a lot of the same thing over and over and over again with different numbers in this chapter. Well, that's the world of accounting. Once you get the standards, you just replicate that. So chapter 13 here is all about long-term liability. And if you have any questions or want me to slow down or speed up, please say so. You can either type in the chat or use your reactions. I think there's a speed up, speed or slow down button as well. So this chapter is all about long-term liabilities. I think I'm sharing the wrong screen, but this will be quick. So obviously last week was current, this year's long-term. So it's anything that we typically would pay after a year. So something that we will hold as a debt of the organization for a year or longer. It does say here within 1 year or one operating cycle. Very rarely does an organization have an operating cycle of say 2 years, 3 years, 15 months, whatever that is, but it could happen. So it's typically anything 1 year or longer. Yeah, and these, common examples are bonds, mortgages, notes payable, and they all follow the same calculation process. And notes payable, just like a bonds payable, very similar. Notes payable is about a promise to pay a specific sum of money at some point in the future. And they're typically measured at fair value. Fair value is determined based on present value. So if you have hopefully used the present value calculations before, either on a calculator or in Excel, you will use it a lot for this chapter if you have not already. And hello, Gladys. So then there are a lot of similarities, whether it's a bond payable or a note payable. Again, they're always measured at par or face value. They're issued at par or face value, but they're accounted for based on the market value. Then we introduced the concepts of discounted premiums, just to recap on that. If your market rate is higher than your stated rate on the debt instrument you're issuing. So examples are, and we'll cover some today. If say I issue it at 97, that means I'm issuing it at a discount because maybe I'm only paying 5% interest, but the market's paying 7% interest. So if the market, they could earn more than what you offer, you would be typically in a discount situation. And the opposite is true. So in a premium situation, if you're paying higher interest than what the normal market rate is, then you could offer or issue them at a premium, such as 102. So that's what those kind of numbers are. If we issue bonds at 102, that means we are issuing out 102% of the face value. Okay, and we'll walk through some of those examples today. The variables we'll need, if you haven't done some yet, will be your interest paid. So, what's the stated rate on the bond or debt instrument that you're issuing? The interest rate in the market, because that helps determine the discount, the present value. How many payments there are. So if you're making regular interest payment, how many payments there are, and what that future value. So what's the value of the debt at maturity? And hello, Ying, and who else joined Brittany? And I think Gladys there too. And then there might be situations where there might be a restructuring. And again, we'll do one example of that today. So restructuring might happen. You issue a debt over a period of time. Maybe that person or you as the loanee might be in a situation where you can't repay. So there's options for restructuring. So do you cancel the debt and reissue or not? And there's a threshold where if it's more than a 10% change, you would actually restate and restructure. And if it's less than 10%, typically you just modify the terms moving forward. So that's kind of that threshold to remember as we go. Last couple of things to cover, back to bonds. We typically always issue them in thousands. So I've never heard of a bond issued, for $1,376. This doesn't happen. So typically they're multiples of 1,000. So just keep that in mind. They're typically classified as long-term debt because most of the time they're for multiple years. And we recognize them at fair value. So we'll go through those calculations today. Just some differences under ASPE and IFRS. This chapter in this course, we will focus heavily on the effective interest method because it's the most commonly used. And effective interest is the required process under IFRS and optional under ASPE. And under ASPE, you could just do a straight line. Okay, and what that means is if it's straight line, you just record the same interest every year. Versus effective interest looks at the carrying value on your books times the interest rate. Okay, and again, we'll do some of those schedules. So if you haven't done them yet, don't worry, we'll do some together, then you can do some as well. And we'll prepare amortization schedules to show how that debt is paid off over time, or how that debt is amortized over time to end at the carrying value that you will pay off at that point in the future. Bonds issued between interest dates. This, you might have some examples that say maybe I issue it April 1st and interest is payable on June 30th and December 31st each year. So if that happens, if you have an example like that, just remember the prorated period. So always pay attention, excuse me, to the number of periods or months that your interest calculations are on. It's just something that some folks miss sometimes is if you issue a bond that doesn't align with the interest payment dates, you will have to do some adjustments for. Sorry, still have a cough. It's improving. And then when you might de-recognize a debt, so you might pay a debt early, you might be released from debt by the creditor, you might be able to pay it at maturity. There are processes around what to do at that time. And there might be a call premium. So there's a couple of examples we've given in this chapter where debt was issued and we have the right to pay it off early or to call the debt at maybe $104, or 104, a 4% premium. So, well, we have some examples of that in this chapter as well on what to do in those situations. And at any time where you are reacquiring the debt, any unamortized premium or discount, and any costs of the issue are amortized to the date of reacquisition. So again, pay attention to those dates. Sorry, it's also a whole bunch of noise from the kids in the background. So just whenever there's some derecognition and changes in terms and paths, you want to take any remaining premium or discount unamortized, and we want to amortize them to the date of that reacquisition. So you always kind of spread that over the period of time. So that's kind of the nutshell what it is. What I'd like to do is get into some questions on it. We'll walk through some examples together, and then we'll actually create an amortization schedule together. Questions so far, or have I lost you all? If you want to follow along, I'd encourage you to open up this Google Doc link under Chapter 13. I'm just going to take a drink of water. So if you open that Google Doc Chapter 13, we'll walk through some questions together. Yeah, I've got it open here. Okay, it looks like one of you are in there already. Oh, there we go. So just to show you where that is, if you want to click on it. It's under the content, Chapter 13, Google Doc, Chapter 13 link for class. So I see a few of you in there, and we'll start, actually I'm gonna blow this up a little bit more. And we'll start at the top. So same kind of thing, looking for input, how would we calculate these? And then I'll make sure that we are correct in spelling them out. So the first question here is, what's the interest payment for a $400,000 5% bond that pays interest semi-annually, and we're told that the market rate's 4%. So then we have to focus on what is it asking us for? It's asking us for the interest payment. Somebody want to take a stab on how we would calculate that? Just give you a minute to think or type. If you're not comfortable typing in the Google Doc, you can always type in the chat, whichever works for you. If somebody's typing or not. So let's just recap. Interest equals the face value, almost, times the interest rate. I can't type. Interest rate divided by 12 months times the number of months. Okay. So in this situation, we've got a $400,000 bond. Okay. And your 8,000 will come back to that in a moment. Unfortunately, it's not quite right. So our rate is always based on the stated rate. So the interest payment is always based on the stated rate on the bond. So we'll take the 5% times the 400,000, and then we'll divide that over 12 times the 6 months for the semi-annual payment. So our interest payment in this case would be $10,000, not 8. And I'll comment, I'm assuming you use the market rate of 4% calculation. Whoever typed that. Yes, perfect. And just remember, in this component, we only use the market rate when we're calculating present values of bonds. So when we're calculating interest payments, it's based on the stated interest on the bond. The market rate only comes into play when we're determining present value. Okay, and we'll do some of those questions in a moment. Okay. The fact. I don't know how else to say. Only use the market rate for present value calculations, otherwise the face stated value. Just watching for other questions or comments. Otherwise, we'll move to question 2. And for those that may have missed it, if you want to follow along in the Google Doc, it's under chapter 13. So link for the file here. So we'll move on to question number 2. So thinking about the rates where we say we issue something at 103, how do we calculate how much cash is received? So if it's a $600,000 face value bond issued at 103, how much cash do we receive? I'm just seeing if I have any takers. So in this case, when we always say we issue it at 98, 102, 103, 107, whatever it is, we always treat that as a percentage. So we can take our 600,000 times 1.03, so 103%. So the actual cash received, if we issued this bond at a rate of at 103, we would actually receive $618,000 of cash from that lender. If it was issued at 97, you would just go equal 600,000 times 0.97. So this one's at 103, and this one's at 97. Just watching for questions. Or thumbs up, just power through. Any indication would be helpful. Perfect, thank you, Brittany. All right, so let's move on to question 3 then. Question 3 says, how would we do the journal entry? Because we're accountants, we're all about journal entries at the end of the day, not just doing present value calculations. So what would be the journal entry? Anybody want to take a stab? I'll go back. There's a question in the chat. Question 1 divided by 12. Yes, because the interest rate stated is for the year. So we have to divide it by 12 to get our monthly interest. and then we times by 6 because it's half a year for 6 months. So it's basically take half of that interest for the year. Does that help? It's either times 1/2 or divided by 12 times 6. And that's what I'm saying here. Interest rate divided, so fair value, face value, sorry, times interest rate divided by 12 times 6 is the same as times 1/2. Either way, semi-annually times 1/2 or 6/12, power of fractions, either one works. Okay. And I see someone's typing in their suggested journal entry under question 3. So we have cash of 618 debit, yes, because cash is increasing. And our bonds payable is a credit for 618, correct. So in the future, we will owe that bond. Okay. And yeah, it's as simple as that. Just pause. Any questions, comments, thoughts? We're starting out relatively easy. I got 1 thumbs up. Thank you. All right, let's move on to question 4 then. Question 4 says we have a $500,000 5-year bond issued at 98. Interest is paid annually. Assume the company follows ASPE. How much is the amortization? So in this, we have our face value. Okay, I'll walk us through here. We have 500,000. And we have the carrying value, which we don't have to do the present value calculations because we're told it's issued at 98. So we take the $500,000 face value times the 98. Where's my? All right, pet peeve when there's no commas. So carrying value of 490. So our discount here is $10,000. Okay, the difference being the 10,000. In this case, under ASPE, we can assume that it's straight line, right? Because ASPE can be straight line or effective interest. We're not being told to use effective interest, so we can assume straight line. So if we have our amortization period is 5 years, we can simply take the $10,000 difference divided by the 5 years. So our discount is amortized at $2,000 per year. And again, we'll do a schedule later on, but perhaps on this one, just to show you quickly, is if we have our opening carrying value of 490, I'll just link that here. Yes, this is a discount. So we have our opening carrying value of 490. Every year, we'll be amortizing $2,000 of the discount. What that's doing is it will grow the value of your bond payable up to the face value by the time it matures. So I got questions in the chat coming in here too. So yes, it's a discount. And the carrying value is your book value, not the face value. The whole point is you want to get your carrying value equal to the face value by the time of maturity. Another way to look at it is if that bond was called early and you paid it off early, typically you would pay about the cost of your carrying value, not the face value. Okay. You'll see more of this on the asset side of things when you're the issuer. Face value is the bond value itself. So right here, a $500,000 5-year bond, that's your face value. So $500,000 is what I'm paying interest on, and that's what I'm expected to pay at maturity. So face value is the $500,000 in this case. The book value or the carrying value pulls into play any potential premiums or discounts. Okay, so based on your rate versus the market rate, there's some differences there, as well as you will present value the future cash interest payments. And again, we'll do some more of those examples that might help. Okay, Ying? Okay. So let us get to some of the other exercises later. Hopefully that'll help paint a better picture. Question 5 here. Sorry. And anybody can feel free to start typing if you think you know, that's fine. Question 5, we say on January 1st, the company issued $1 million, 4%, 20-year bond. Interest is paid semi-annually. The market rate is 6, and we're asked to determine the present value. So in this case, we're not told that it's issued at 107 or 97 or whatever it is. We actually have to calculate the present value of this bond. So the power of Excel, if you haven't used it before, there's a built-in present value function. But if you have a financial calculator, it follows the same process. So I'll just itemize for you what we need. Whenever we want the present value, the PV, we need to know the rate, which in this case, our rate is 6% per year. But in this case, we're paid semi-annually. So we need the rate of interest per payment. So in this case, if it's 6% per year and it pays every 6 months, we need to take 3%. Okay, so we need 3% is our rate. Then we need our number of periods. Our number of periods are the number of payment cycles. So in this, it's a 20-year bond. We will be paying interest to the bond issuer twice a year. So it's 20 years, 2 times per year. So we have 20 times 2 will give us 40 payment periods. Okay, so every 6 months, we're making another payment for 20 years. Then we need to know how much are we going to pay them every 6 months. To calculate that, it's based on the stated interest rate. So it's our stated interest rate of 4% per year, 4% per year, times the face value. And in this case, we need to go times 1/2 because it's paid twice a year. So if it's 4% per year interest, it's 2% every 6 months. So in this case, and because it's cash that we're giving back, we're sending it out of our organization, we need to enter this payment as a negative. So we'll go negative 1 million times the 0.4% times 1/2 of that, or divided by 2, whichever works for you. Oops, Google Sheets doesn't like that. There we go. $20,000 is the amount of interest we will pay every 6 months. Then, do we know the future value? The future value in this case is how much will we pay at the end? So we will owe the bond issuer $1 million in 20 years from now. So that's our future value. The future value of our bond will be $1 million. So in 20 years, it'll be $1 million liability on our books. We'll pay it off and we're done. Okay. And then the last part that you typically need to know is the type. Excel, if you're using Excel, will default to 0 as your type. 0 means you're making the interest payment, the $20,000 payment, at the end of the interest cycle. So we're paying it at 6 months and at 1 year. We're not paying it in day 1. Some parts of this course, especially when you get to capital leases later on, the type might be 1, where you're paying it at the beginning of the term. So you might pay initially at day 1 and then day 6 months plus 1. Okay, but type 0 is the most common for long-term liabilities in this chapter. So now that we have all of these drivers, we can determine the present value. So if you have a financial calculator, you can use the rate, the end per payment, the future value, and you'll come up with a number, hopefully around 769,000. hoping Google Sheets has this formula. I didn't even think to check. There we go. So equals PV is the formula that we can use. And then we'll do an open bracket. And you can see it tells us what do we need first. So we need the rate. So we can actually, I don't know if it's going to like that. It doesn't like that. There we go. Equals the PV of the rate. Then we'll put comma. We need the number of periods, comma, the payment amount, comma, the $1 million future value, comma, and then we'll put the type of 0. Okay, so I'll pull that back up so you can see it. So it's the present value of the rate, then the number of payments, the annual interest that you're going to pay, then the future value that you will owe at the end of the cycle of 20 years in this case, and then the type, in this case being 0, because we're going to pay at the end of every 6 months. I'm going to pause there. Any questions on this or thumbs up? Keep going. Got one. Thanks, Gladys. All right. So our present value then is the 768. So we can type it there. I'm not going to type it. I'm just going to link it. There we go. And let's see, number 6. If you recall, we talked about this at the beginning of class. If the market rate is greater than the stated rate, will the bond be issued at a premium or a discount? P or D, premium or discount? See if I have any takers. So if our market rate is greater, that means they could earn more elsewhere. Somebody typed it, great. It would be offered as a discount, correct? Discount. Good, thank you. Question 5 says, let's prepare the journal entry, sorry, 7, prepare the journal entry for number 5. So, you know what, we've already done one of these. We'll just copy that down. So we'll have our cash for the amount of 768,852 as a debit, and a credit to bonds payable, 768,852. Okay. So if we go and basically what we're saying is if we borrow $1 million future debt for 20 years, the person giving us the money today is only going to actually give us 768,000. And it's going to grow over time to the $1 million that we owe. Just watching for questions. All right, so question number 8 then. On July 1st, a company that we have decided to retire some outstanding bonds. And we're given some information. So the face value on the bonds is 750. Thank you, Gladys. The carrying value, so the amount on our books, or our book value, is 720. And we're told a retirement value. So there's a premium in this case, being at 101. So in this situation, we would have our bonds payable liability we need to get rid of. And the value in that account will be the 720. So if it's a bonds payable, it's a liability, it's a normal credit. We need to debit bonds payable to get rid of it. And then we have how much cash is it going to cost us. We're told the cash retirement factor is 1.01. So we take our 750 face value times the 101 as a percent. I'll divide the 101 divided by 100. So the actual cash that we will send is $757,500. So that gets rid of our liability. We send that cash based on the negotiated retirement value. And therefore, whatever difference there is, in this case, it is a debit that we need to have for $37,500 to balance the transaction. And that would be a loss on redemption of bonds, typically under other comprehensive income on a financial statement. Okay, questions on how this was calculated? You can repeat it, or thumbs up, carry on. It's Brittany. All right. And then we'll do a couple schedules shortly, but anybody won't know what the headings are on an amortization schedule? It's the same 5 columns. So you can just memorize this, and when we give you a problem, you just have these 5 headings. Anybody want to take a stab at what those are? Not having any takers. It's okay. So we'll have our date, so the transaction date, the cash that's actually going to depart from us, the interest, any amortization of the discount or premium, and then we'll have the carrying value, the CV. The cash going out will always be calculated based on the stated rate on the bond times the face value. The interest in most cases will be using the, and this answers question number 10, the market rate. So that's when you're using the effective interest rate on bonds, you will use the market rate times the carrying value to determine your interest expense. And again, we'll do an exercise on that in a moment. So those are kind of the key items from this chapter so far. Before we flip over to do some exercises, any points of clarity required so far? Or are all your eyes spinning in circles? I don't know what my kids are doing downstairs, but man, they're loud today. Hello, Brittany. Thank you. Teenagers. All right, let's jump over to this. So you already have the solutions for these exercises, but I thought it'd be helpful to walk through a few of them, just so you can see how it comes about. And then if you want others as examples, we can do. But I figured I'll just do a few of them just to demonstrate. Is that okay? Any objections? Thumbs down, you want to go, or thumbs up? That sounds like a plan. Couple, thanks, Elizabeth, Brittany, good. All right, so let's go to question number 1 or example number 1. So if you want to pop open these Excel files, feel free. So it's under, I can go to the right spot. Under content, you have the chapter 13 examples, and that pulls up this file. So in this example number 1, we're given, sorry, Orlando Limited. They issued a $992,000 10-year bond, and it's dated January 1 of Y2. Doesn't matter what Y2 is, could be 22, whatever. The bond was sold to yield a 12% effective interest rate, and the bond paid 10% interest on January 1st and July 1st each year. So the first thing we're doing is we're asked to determine the present value of the bond and prepare the amortization schedule and then journal entries. So if you recall, just to recap the items we need to have to calculate present value. Okay, we need the rate, we need the number of periods, the amount of payment that we're going to make, the future value, and the type. So anybody want to tell me what the rate is in this case? You You can type in the chat or you can unmute. Maybe next time I'll throw this on Google Docs too. No takers? What are you thinking? So in this case, it's a rate of 12% is what we're sold. Okay. So we need a rate of 0.06 or 6% because it's paid every 6 months. We're told that it's a 10-year bond with 2 payments per year. So we have 20 periods. To calculate the actual payment that we're going to make, it'll be the 10% interest, but paid twice a year. So it'll be a negative payment because it's cash going back, cash going out of the 992 bond face value times the 10% divided by 2 because it's twice a year. So we'll be spending $49,760 twice a year on interest. Our future value is the face value, 992. And our type is 0. We're told that we're paying 6 months out. So we're paying at the end of the term. And then we can use our fancy dancy present value of the rate, period, the payment, the future value, and the type. And what do we have here? 878218 and some pennies. So you can always round that if you want, just for simplicity, or you can leave the two pennies. Questions on the present value calculation? Okay, so now we can set up our schedule. So we've got our dates, our 5 columns, our date, our cash, our interest, our amortization, and our carrying value. So our carrying value at day 1, which we're told is 0101 of Y2, our initial carrying value then is our present value. So on day 1, January 1st of Y2, we would have a debit to cash and a credit to bonds payable of this amount. Then we'll go every 6 months. So I'm not going to type all of these, but July, and then 01 slash, where are we? Year 3, et cetera. Actually, looks like they're in here. A little different format, but that'll work. Okay. So now we've spelled it out for every 6 months. And if we highlight these, all of these payments here, we've got 20 of them. So it shows our 20 periods. Now, to calculate this, our cash payment, we've already identified what amount of cash we will pay every 6 months. That's this $49,600. So we'll pay the $49,600. So that's our cash. Actually, let's break that down. Our interest has to be our market rate or our effective interest rate. And then up here, we're told our effective interest is 12% per year. So in this case, we need to take half of that because we're paying the interest installments twice per year. So in this case, I'm going to calculate my carrying value times my interest rate. I'll round it. I'll keep 2 decimals. Why not? I'll fix all of this as we go. And our amortization is as simple as the difference between the two. So in this case, yes, so our interest, take away the cash, we have 3093. And that amortization will add, oops, wrong way, will add to our carrying value. So you'll see our carrying value will slowly get closer to the 992,000. Now, the way to think about this is debits and credits wise. This line here, the 49.6 will be a credit to cash. Okay, just to think of where things are going. The interest expense will be a debit to interest expense. I should have put that first. So debit to interest expense. So therefore, right now, our debit is greater than our credit. So we need to credit bond payable. So therefore, it's making our bond payable, our liability, bigger. Okay, so just to show how that entry is working. Once we set up those formulas, actually, then we can just drag and copy them down, and we're out a penny. Let's just round this. That happens. I'm not too worried about a penny, but you get the gist, 992,000. So what we can do now is pick any point in time, and we have our journal entries based on the schedule. So for example, if we went to January 1st of year 6, it would still be a credit to cash for 49.6. We had debit to interest expense for the 54,250, and then a credit to the bond payable for 4650. Okay. So all of our data needed for our journal entries for the life of this bond, boom, on our amortization schedule. I'll pause there and see if there are any questions or anything you'd like repeated about this. Thumbs up, you're good. Crying face if you want me to do something again, and that's okay. I think I lost other people, or are you still thinking? I'm always told you have to take purposeful silence sometimes. All right, thank you, Elizabeth. All right. Let's jump over to example 3, because example 3 is ASPE, so it's straight line. Okay, so a lot easier. So it's straight line amortization. And in this case, we have a 1.1 and change $1 million bond. It was sold at 98. So for these, all we need is our face value and our present value. I can't type value. So our face value is 1148. And our present value was the face value times the 98 that it was issued at. So we don't actually have to go through the whole PV calculation. And therefore our difference is the 22,960. Now we're told it's a 10-year bond. Interest is paid twice a year on January and July. So therefore we have 20 periods. So every 6 months, we will amortize some of this discount. So we'll take the 22,960 divided by the 20 years. This will be our amortization per period, which is every 6 months. So how this looks from a journal entry perspective, anybody want to take a stab to say it? Or would you rather me just type or paste it in? In this case, our initial issuance, we would have the cash in of 1.125, which is the present value. Because it was issued at 98, we only received 1.125. And then we have our liability of our bonds payable. Oh, wrong button. Nope, I didn't think that would work. So I need to calculate the amortization. Here we go. There we go. So then our interest payment on July 1st of year 4 would be our cash payment of $57,400. Okay, how do we get to $57,400? Anybody venture a guess? Well, it's actually in the formula. We take our face value again, times the stated interest rate at 10%, and then divided by 2 because it's paid every 6 months. So our cash out is $57,400, and we know that our amortization is straight line, so it's $1148, and then you just add the 2 to be our interest expense. Now, actually, I want to walk through what if you issued it. So this is at 98. What if we issued it, of course, what if we issued it at 102? So what if it was the other way? So we'd still have the same face value, but our present value would be higher. So our amortization would actually be the other way, right? Because it was issued at a premium. This issuance here would be different. So our debit and credit would be the 1170960. Our cash payment would still be the same, okay? But our bonds payable entry, instead of credit to growing our bonds payable to the future face value, we actually need to slowly decrease our bonds payable amount. So we need to debit our bonds payable in this case. And then our interest expense is the difference. Because it was issued at a premium, our interest expense will always be less than the cash paid out. Let's just make this 103 just so the numbers aren't too alike. How's that? I'm going to pause here. Questions on this? I thought it was helpful to see the 98 and the 103 side by side in this case. Did it help or did it confuse? All right, let's jump over to question 5 then. All right, question 5, we have this situation where this company owes $96,000 to Ontario Bank on a 2-year 10% note. It's due December 31st. The note was issued at par, but we're in financial trouble. The Ontario Bank agrees to extend the maturity date to December 31st of year 6, reduce the principal to only $72,000, and reduce the interest rate to 8% from 10%. Present value of the new debt is calculated at $69,500, and London prepares financial statements in accordance with IFRS. All right. So we're actually given the present value. Look at that. So actually that helps a lot. So we have our year 12/31 of year 4, we're told. It's December 31st. And we have our original notes payable. And our original notes payable we need to get rid of because we're restructuring this debt. So currently on our books, because it's the date that this bond was originally due, the carrying value or the book value would be equal to the face value. Okay, so you have to pay attention on that. So it was due on December 31st, year 4. And they've agreed to extend it 2 years to year 6. So we know that this is year 4. So in this case, we need to remove the original liability. So this is a debit, okay, of 96,000. And we need to set up the new note. So then we'll have our credit to the new note. And in this case, we're told what that amount is. Oops, wrong one. So we're told that the new present value is $69,500. And therefore, the difference in this case, because it's a credit of $26,500, will be a gain on restructuring of debt. Now, let's see. Yes. Questions so far? Okay. So then we move forward, and actually I'll copy this in. It'll be so moving forward. Then, how do we calculate the future years? Well, I have to fix some of that. So here we are. Don't look at these bottom ones yet. I have to fix it because the links didn't work. So here we are. We have the interest expense then is based on the interest rate of the old debt, okay, because they restructured it for a short period of time. So in this case, we have the 10% on the new debt of 69.5. So our interest expense will be the 6,950. However, the cash we're paying out will be based on the new debt instrument. So our new debt instrument would be 72,000 times an 8%. And it's paid annually. So it's just a flat 8%. The difference then has to go to our notes payable, because the idea again is we need to get our notes payable from 69.5 currently to a face value of 72,000 within 2 years. And then we move forward to the following year. I just need to fix this. So the following year, our interest expense is calculated now on the old debt, which is the 69.5 originally, plus the 1103. Should be 1190. There's a typo in there. Plus the 1190 times the 10%. Again, our cash out's the same, and then our notes payable adjustment is the difference again. And then our notes payable, I've got a one rounding just because the way things rounded. We would clear out in December 31st of year 6 for the $72,000. What would be helpful even in these cases, I'm surprised you didn't put in one, but an updated amortization schedule that supports these numbers. So what you would see, sorry, would be your carrying value, your new carrying value would be 69.5. Let's pull. Oops. Okay, so then our cash out would be the 5760 here. And our interest portion would be the 6950, well, or equals. Okay, if our amortization is the difference. I did that backwards, yes. Okay, so there's our entries. And there we go. So a little schedule just to show, again, the effective interest rate method from the restructure date to the end. We just re-amortize that gap accordingly. Pausing, questions, concerns, thoughts. If you want to do more of these, that's what this whole chapter is about. We can do more, or I can let you go and work on it and come back with questions. I know we're approaching an hour, so I want to give you a few minute break at least. It's a matter whether you want to stay on and do some more examples, or just take the time to do some work on your own. How about thumbs up? Let's do some more examples. We'll just take 5 minutes, just if you want to get some water. Or thumbs down, you want to go and take off and do some work on your own. Okay, Brittany. And if there's some that, if there's some that want to go and some that want to stay, that's okay too. You won't hurt my feelings. Okay, so let's take 4 minutes, just a quick break. If you need a bio or some water, we'll come back at 5 o'clock. It's 4:56 now on my computer here. So we'll come back in 4 minutes because I need a quick little break too. So I'll be right back. All right, so let's move on to question or example number 7. So example number 7, and you'll see, hopefully the path or the pattern shortly. So on January 1st, year 5, Sky sold 15%. Oh, nice, 15% bonds, having a maturity date of maturity value of 860, and we sold them for 920, which provides the bondholders with a 13% yield. So we're already told the present value. And we're asked to prepare journal entries with date of issue, the amortization schedule, and prepare a bunch of other entries. So because we're already told the present value, the first part is done for us actually. So in this case, our cash on issuance would be the 924.97. So a debit to cash and a credit to our bonds payable, the amount. We're told how much we sold them for. So then our amortization schedule, amortization schedule, we would then do the same that we've done in previous examples. In this case, our dates would follow on the left, starting with year 5. Our carrying value would start with the 924.97. To calculate our components within this table, the cash, so the the cash paid would equal the $860,000 maturity or face value times the 15%. Okay, and these are paid once a year, so there's no half. So if we look here, our cash is 860 times the 15%. Our interest expense portion needs to be the market or the yield, in this case being 13%. So our interest is equal to the carrying value times the 13%. So it's the yield. Okay, so it's our carrying value times 13%. And the principal adjustment or the amortization, we'll call that amort. Okay, is the difference. So our cash less the interest is a 935. So therefore, because it was issued at a premium, 15% is greater than 13, we need to slowly decrease our carrying value. So our 920 is then decreased by the 9,000. Again, if you think through the journal entries, we're giving up cash, credit to cash 129, and we're debiting interest expense for 119. So therefore, our credits are bigger than our debits. So we need another debit. So that debit is going to our bonds payable, which means it's declining. So our 920 becomes 911. Carry on the schedule the same way. Again, interest is always the previous carrying value times the yield. We get to a closing value of 860,000. Yes, again, a $1 rounding. Questions on the amortization schedule? All right. So then we're asked to create entries 12/31 year 5, 01/01 year 6, 12/31. So these are all the year ends. So we obviously year ends 12/31, we need to accrue the interest payable. And then on January 1st is our interest payment date. Okay. So in this case, our entry as of December 31st, year 5, we pull from our schedule. So we'll have our interest expense of 119. Our interest payable, it's not cash yet, on December 31st would be a credit of 129 because we'll pay it the next day. And then our bond payable adjustment accordingly of the premium. So our bond payable is reduced on December 31st for $9,335. The next day, January 1st, we pay off the liability. So that one is as simple as credit cash, debit interest payable, because we're just recording the cash payment. I'll pause for a moment. Questions, comments? Then we carry that on for the next year. So we can see in our schedule the second year, our interest expense now has decreased down to 118,451. Our interest payable is the same amount, 129, and therefore the difference is our adjustment to our bonds payable again. And then rolling forward to January 1st of year 6, we will pay off that 129 owing. Any questions? Sorry, I'll zoom back in so you can see these numbers. Any questions on example 7? All right. All right, so I'm going to jump over to question 9 then, if that's all right. So question 9 has a slightly different component to it here. So question 9, we have this company, Elmer Limited. We issued 12% bonds. Par value is $750,000 and due in 20 years. They were issued at 98 and were callable at 104 at any date after June 30th of Y10, which happens to be 7 years after the issuance date. Because of lower interest rates and a significant change in the company's credit rating, it was decided to call the entire issue on June 30th of year 10 and to issue new bonds. New 10% bonds were sold in the amount of $938 at 102, and they mature in 20 years. The company follows IFRS, uses effective interest rate. Interest payments are December 31st and June 30th. And here we go. So we need to start this question by creating the initial amortization schedule, because we need to determine what are the bonds value as of June 30th, year 10. So the first thing we will do is create our amortization schedule. Zoom out just a little bit so you can see your dates. Okay, so we can set up the structure the same as we always would. We're told that the carrying value, the original value, was issued at 98. So we can take our 750 times 98. So it was issued at 735. And now we need to do some calculations for this. So our cash payments, first of all, we're told 12% every 6 months. So our cash payments will be 6% times the 750. So $45,000 every 6 months is our actual cash payment on this. But to get our interest, we need to know what our effective interest rate is. But we were told what they were issued at, 98. We don't know what the effective interest rate is. We have to actually calculate it. So just like there's a PV formula, there's a rate formula when you don't know the rate. And it follows a lot of the same look and feel. So you need to know, we're trying to find out the rate, we need the periods, the payment, the present value, and the future value. Since we know the PV and FV, we can back into the rate. So in this case, we're told it's 40 periods, 20 years, 2 payments per year. We know the payment's $45,000 every 6 months. We just calculated that, being the 6% of 750. Present value, 735, we know that. And that's a positive number because that's cash coming to us. 750 is future value, which is the cash going back out at the end. And then it's type 0 because we pay at the end of June 30th and the end of December 31st. So then just like the PV formula, there's a rate formula. So we'll type rate, number of periods, our payment made every period, our present value, our future value, and our type. We can ignore the guess, it's not a required component. So if we expand this a little bit, You see a whole bunch of decimals here. So we will use 6.135 is our effective interest rate. So let's type that, 135%. Questions on the rate formula before I continue? Are you still with me? Thank you, Elizabeth. All right, so in this case, now that we have our effective interest rate, we can use it to calculate our interest expense each year. So then we will take our effective interest times the carrying value. So we have 45092, should round all these. And our amortization is the difference. And in this case, we are growing our carrying value to eventually be 750 in 20 years. So we can, oops, boom. And let's format this. All right. Questions on the amortization schedule so far? All right, so we stopped the schedule at 6:30 year 10 because that's the date of the call, and that's the date we are calling them. So now on our books, the carrying value as of 6:30 year 10 will be 736,958. So we have our amounts to use for our journal entry. So our entry as of that date, okay, will be our bonds payable of 736,958. So it's currently a credited liability. We need to debit that bonds payable to remove it. The amount of cash that we receive, because it was called at 104, it says. So it's callable at 104. Where was that? Right here, callable at 104. So we take the face value of 750 times 104%. So there's a premium on it because they called it earlier. So 780. And then we have a loss on redemption of bonds. Okay, so unfortunately it cost us more than we anticipated because we canceled the bond early. And now it says we reissued new ones. Sorry, 2 seconds. So now it says we reissued new ones or borrowed new funds at a different rate. So in this case, our bonds payable is the new 938,000 issued at 102. So we take the 938 times the 102%. So the total cash in now would be 956,760, and the bond payable, our liability, is now a credit of 956,760. So that's the new face value times the 102 it was, right? Yes, 102. And again, we need to determine the effective interest rate. We're told the 102, but we don't know the effective interest rate. So we need to do the same thing here. I'll just copy this down and we'll update the data. So in this case, we still have 40 periods because we're told right here, it's 20 years again. So it's still 40 periods. The interest rate was, let me see, it was a 10% bond. So it's 10, because it's paid twice a year. So it's 5 times a 980, right? It's a 980. No, 938. Sorry about that. So it's a 5% paid every 6 months on the 938 face value. So let's put that 5% of face value. Our present value, we just calculated that over here. And our future value is now 938. So we have a rate calculated in this situation of 4.885. Why that's important is because when we're calculating our interest expense at the next point in time, And I just realized this date's wrong. There we go. So the December 31st interest payment, in order to determine what that is, we need there we go. So we have our cash out, 46.9. We know that that's the amount we're going to pay every 6 months. The interest expense is calculated based on the effective interest rate, which we calculated here, 4,885 and something. So interest expense is 46,740. You might round a little different within a couple of bucks. That's okay. And the difference goes to bonds payable again. So we're slowly reducing our liability by 160 in this case. If you wanted to set up a schedule like we did up here, just so you can see, so our original carrying value then was 956, 4.885, say. Our cash payment is 0.05 times 938. Our interest expense, I gotta bring this down. And then our amortization. Yeah, see, it's rounding a little different than in this one because I reduced the percentage from multiple decimals to just 3. So you can see over time, our carrying value of our bond is getting closer to the 938. Any questions on that or any points of clarity? If you don't use Excel much, this is a great time to use it. Thumbs up, carry on, or thumbs down, you're thinking of a question. All right, I wanted to do one more together today. Is example 14. So example 14, we have Elmer Inc. We owe London Bank 200,000 plus 18,000 of accrued interest. The debt's a 10-year, 10% note, and our business declined, unfortunately. On December 31st, the bank agrees to accept an old machine and cancel the entire debt. The machine costs so much, accumulated depreciation, fair value, and the bank was going to sell the machine and incur the disposal costs. So we want to prepare the entries for both organizations in here, just so you can see what the impact would be on what side you're on. So let's start with Elmer. Okay. In this case, we have a bunch of items we need to clean up. So the first thing is we have a notes payable on our books that we no longer will have. So it's a liability. So it's the current credit balance. We need to debit it. 200,000. Okay, so that's the amount that we owe. We also have interest payable on our books right now. Sorry, 18,000. So these are debits. Let's see, debit, credit. And then we need to remove the asset that we're giving them. So we have accumulated depreciation, we're told. And we have the machine itself. So the accumulated depreciation, we're told, is 221. And the machine had a cost of 390. So then we'll have two other components. We'll have a gain on disposal of machine, and we might have a gain on restructure of debt. So just got to double check my notes to make sure I'm not saying anything wrong. So first thing we want to do is determine the carrying value of the machine. So that's our net book value. There we go, 169. We're told the fair value is 180. Therefore, since the fair value is greater than the carrying value, it's equal to a gain. If it was the other way, we'd have a loss on disposal of machine. So we'll have a credit to gain on disposal of machine for the 11,000. And then for the loan, we have the carrying value of loan, which we're told is the notes plus the interest payable. We're getting rid of both, so they're both considered part of the loan. And we're trading for the fair value of the machine, which is the 180. Therefore, because we're giving a machine that's worth less than the liability, we have a gain on the restructure of debt. Because we're giving up a liability at 218, but we're only losing a machine worth 180,000. We have our credit to gain on restructured debt. Now, just to make sure our debits and credits balance, and they do. Okay, questions on that? So that's Elmer's side. All right, let's look at London Bank side. So on London Bank side, they have the machine now in their possession, and they will now record it at the fair value. I'll come back to this for a second. I'll come back to that. Okay, so in this case, now on their book at the London Bank, they had a receivable from our company of 200,000. So we need to remove that. So it's a credit to the receivable. We would have also accrued the interest receivable of 18. And assuming that they had a, assuming they had an allowance for doubtful accounts on their books, then the difference of what is this, 38,000? Yeah, $38,000 difference would go to their allowance for doubtful accounts. Now, if they don't have an allowance, this could be bad debt expense. Okay, but most organizations, especially banks, will have an allowance for doubtful accounts on their books. So you would record that accordingly. Questions on this example? So in this case, looks like Elmer did well. Through this transaction, they picked up income, other income of $49,000. Not hearing any. That's all I want to cover today. Unless you have other examples you would like to follow. Otherwise, I encourage you to do some more examples, maybe do some more review, reach out with any questions, and then don't forget the quiz on FOL over the next few days. If you drop, have a wonderful weekend. If you want to unmute or type in the chat, feel free. You're welcome, Elizabeth. You're welcome, Gladys. Hopefully you're still there, Brittany. I know it's hard doing these Zoom classes like this.